The Financial Planner, presented by the Bombay Stock Exchange, IPF.
Hello and welcome to this very special episode of Financial Planner. Over the week, we've been taking step-by-step direction in helping you understand the equity markets. Now, we are done with understanding what is a primary market versus a secondary market, IPOs, FPOs, how to read the balance sheet of a company and so on and so forth. And the next step, therefore, is what are the products that you can invest in an equity market? So joining us to take us through various kind of investment opportunities that the markets offer is Jayant Pai from Parag Parikh Financial. Thank you very much, Jayant, for joining us. Well, earlier in our episodes we discussed about, how to identify a right stock, which is a good company to invest in. But there are various modes to invest in a market. One, of course, is a primary market, when a company comes and offers the shares. And the other is when the company is already listed and it has various other opportunities. So we are talking about secondary market. To begin with, if you could just as a reminder or a recall value, identify between the primary and the secondary market.
Yeah, the primary market is actually what the term capital market refers to, where the actual capital is raised by the companies. So the companies approach the lay investor, and it's a medium of actually where the money comes into the company. Once that happens, the company issues something known as an equity share to the persons who have given it money. And these equity shareholders will now be holding the shares, but then they should have a mechanism or a platform to actually sell these shares if required, because the companies will not be there as market makers to buy these shares back. So this platform, which can be either electronic or physical, this is known as the secondary market.
Okay.
When existing shareholders could offload their shares to certain new buyers who would be interested in getting into the company.
So there are different sort of modes that one can look into it. One is like in a generic basis. Say I have bought shares of an X company and I now want to sell those shares because now I think I want to exit for whatever reason, for profit making, or I need money or cash or whatever. So when I sell it to another person, the shares of a company X, that means I'm trading in the secondary market in simpler words, right?
Yeah.
Okay. Now there are different kinds of categories. You have your rights issues, you have your bonus shares, preference shares. Now let's go step by step into understanding that. What are rights issues or rights shares?
Rights issues is a secondary stage of fundraising. For instance, once the company raises money initially, they may always require money in the future. So they have two options: either approach the same set of shareholders again with a request for more money, or approach a fresh set of shareholders. Companies may prefer to approach the same set because there is a sense of familiarity that the investors have with the company. So the marketing costs are also lower, because they are able to raise the funds more economically. And also, so always a rights issue is something which companies prefer the first. And also in terms of promoter shareholding, for example, rights shares may be offered in a certain ratio to the existing shareholding. For example, if somebody holds 100 shares, they may be given a ratio of 1:2. So that means 50 extra rights shares for every 100 shares held. And the shareholders then give a certain consideration to the company, and that's how the company raises money. Now when this happens, the existing promoter shareholding is not diluted. For example, if the promoter used to have say 51% earlier, even after this fundraising, the shareholding pattern will remain the same. So that's why promoters prefer this as a means of raising money.
So rights issue essentially is for the existing shareholders?
Yes. Actually, theoretically it is only for the existing ones, but the existing ones have a right to renounce this right. I mean,
and that is why the term, it comes as rights issue, that I can say that I may not want to use these, the split or whatever that they would be looking at doing. Is that correct?
Yes, and in case they do want to renounce this right, they have the option of selling this right to any outsider. So that way some outsider could come in, but only if the existing shareholder renounces their right.
So essentially the existing shareholders gets the opportunity of having more shares than what he already holds.
Yes.
And he has also the option that he may or may not take that right that has been offered to him.
Sure. Yeah, that's how it is. Yeah.
In simple words.
Yeah.
Okay. And when you say about the marketing costs are being low, how does it work? Why are the marketing costs low?
Simply because you don't have to go on an advertising blitzkrieg for this. So that's a huge cost.
Cost for most of the companies.
And similarly, even compliance costs. For example, when you do a rights issue, you have something known as a letter of offer. Now the letter of offer, the kind of compliance required for that are less onerous as compared to a DRHP or offer for the public. So even that they do save on legal costs and all that.
Coming back to the next part, which is bonus shares. As the word describes, it's perhaps for your commitment as a shareholder of a company, you get the bonus. Is that correct?
Bonus shares are often regarded as a free gift by shareholders, because it is see that the official term or the theoretical term is capitalization of reserves.
Okay.
Here what the company does is in the balance sheet, since you have covered balance sheets earlier, you will have a thing known as equity capital and the reserves.
Yes.
Reserves comprise various things, but this a time may come in the company's life when the company feels that either the liquidity of the stock is too low. A company may be performing superlatively for the last, say, decade or so. So they have never approached the market again for money. Okay. This happens in case of many MNC, FMCG companies and even pharma companies. So they have built up a huge war chest. But at the same time, what is happening is, because the number of shares are very few in the market, the shares are absurdly priced. And also they are out of reach for a large cross section of investors. So here what they do is it's a book entry wherein they transfer some of these reserves and convert them into equity shares.
Okay.
And hand over these equity shares to the existing shareholders,
or allot the same to them.
Allot the shares, and usually, just as in the rights, even here the ratio is predetermined. So the ratio could be, say, again, say 1 share for every 2 shares held. So if I'm holding 100 shares, I will get 50 shares as bonus. I don't have to pay any consideration for that. So shareholders like this thing, because they deem it as a free gift. But what happens is that the share price proportionately adjusts to this excess issue of shares. For example, suppose the share was 150 and then you allot, say, 1:2. So the share price will fall to around 100 to adjust for this.
Okay.
So your net worth may remain same, but this is more of a signal by the company of their confidence in the future, because whenever you allot more shares, it's more or less a permanent liability that you are entering into.
Jayant, help me understand this. So what you're saying is that if, for example, I hold about 10 shares of a particular company which is priced at about 150, I may get about 50 more shares, that becomes 150 shares at 100 rupees.
Yes.
So as you said, my net worth remains the same, perhaps. But in that case, as you said, that the confidence is being given by the company that they're giving more additional equity shares. But the point is, I as a shareholder may or may not be happy with extra shares. I would rather have the price at 150 and 100 shares than 150 shares at a price of 100. Do I have, like in a rights issue, do I have an option of saying, sorry, I do not need these bonus shares?
No, you do not have that option. And even if you have that, most would not exercise that, because net at least you are not worse off.
Okay.
And always there is a hope that once more shares enter the market, the liquidity could improve, or there could be certain other positive spin-offs.
In some cases, the net worth can also be higher, need not necessarily be the same level, right?
Certainly. I mean, when I say adjust, I only mean the immediate opening price after adjustment. After that, it's purely market driven.
Okay.
So it has happened that, say, a week or two after the bonus adjustment is over, the adjusted price is usually higher. So that's why shareholders are happy.
Okay. Now, there is another part of it, which is the preference shares.
Okay.
Let's move on to that.
Yeah, that is...
I'm the preferred shareholder. Is that so?
Yeah, preference for certain things. Like, actually, preference shares are something which is not very common in India right now. Because there have been certain changes over the last 10 odd years which have reduced the attraction. But preference shares in a nutshell are basically a mezzanine sort of fundraising. Mezzanine refers to something in between. So it's neither debt nor equity.
Okay.
So it is something in between the two. So they are shareholders, no doubt, but they have preference as compared to the equity shareholders for two things. One is dividends, and second is here the capital is in many cases actually refunded back after a certain period, while in equity it's usually never returned. So that is one big difference. And as compared to debt instruments, they are less preferred, because the debt instrument holders who are the creditors, they will always have preference for interest payments and capital. Yeah, okay. So that is...
Alright, Jen, on that note, we'll take a short break. We'll be coming up with viewer queries next, and as far as the debt side of it, we'll be taking up those part in our next episode. Well, we'll take a short break. We'll take your viewer queries. As I just was discussing, Jen, we'll be addressing your queries and helping you understand various issues as far as your financial plan is concerned.
The Financial Planner, presented by the Bombay Stock Exchange, IPF.
Welcome back to Financial Planner. It's that time when we take the viewer queries.
Investment Ladder, presented by the Bombay Stock Exchange, IPF.
Jayant, we have the viewer query of a 22-year-old Pratyush Jaina, and he's working in a software company and he has a monthly salary of about 19,000 rupees. Now he's given a list of little bit of expenditure and investments that he has done. He has an education loan of about 2 lakh with an EMI of 6,000 rupees. Monthly expenditure ranging at about 8,000 to 9,000 rupees. He has done some SIPs with certain funds at about 1,000 rupees a month.
Okay.
His main question is that he wants to quit his job by March next year to pursue his further studies. I mean, firstly, I think we should applaud at the fact that, you know, when you're entering and your vision is clear, your goal is clear, you're looking at your SIP investments. So I think we can applaud Pratyush for, but your advice on the entire, plan.
Yeah, I wish I was as, mature as him at the age of 22. But it will help us more, if he was a little more precise. For example, there are two things it would be great if we knew that. One is the fee structure for the course that he is proposing to do. How costly it will be. And second is, he has mentioned also some future goals. Now those future goals are vague, so he has not outlined that. But based on whatever he has provided, I mean, what I would recommend is that before he quits his job, I feel it would be better if he either prepaid his education loan or he continued the payment schedule without a break. See, because in education loans there are certain moratoriums. That the bank will not ask for the EMIs will not begin till you begin working, or there are certain things. Now he has already begun working.
Yes.
So the bank, I don't think, will now again agree to any moratorium on payments.
Yes.
So that's one thing. So his payments will have to continue. Second is, even if you look at his, if a future lender wants to lend money for education, they will see that he already has a loan on his books. So that may work against him. So what I suggest is he continue working till he is able to repay. That's one thing. Or he borrow, just make some other arrangements, finish off with this loan, and then quit his job and go in for the next course. Regarding his SIPs, both the funds that he has chosen are good ones.
Okay. And
he has, avoided the mistake which many make of investing in similar type of funds. So HDFC Top 200 and ICICI Dynamic are truly different type of funds.
Okay.
Now, I don't know whether he contributes to Employee Provident Fund at his place. So if he is not, then certain debt allocation should also be done. So I would suggest he invest his balance. See, he's saving a good amount. 21% savings on a salary of 19,000 is really good.
Yes.
So the balance 2,000 he could invest in either the Public Provident Fund, or if he wants to set it aside for some emergencies, an ordinary savings bank account or an FD or a recurring deposit would do.
While he has not mentioned about the time period since when he's been putting on money in an SIP, what would you recommend in terms of continuation? We do not even know whether he'd be able to continue with 1,000 rupees monthly payments once he leaves his job and starts studying.
Okay.
But do you think it will be prudent for him to sort of take out the money, if assuming that he probably would have started a year or so back?
Usually
we still have a year, March almost.
Yeah, we have a few months. I would not prefer that he removes it, because these things will give him the best advantage if he holds on for a long period. But yeah, if there is no other option, then he could use it, because even the amount that he would have accumulated by this time would not be a very big amount. So unless it materially helps him fund his education or for some other purpose, I would suggest he just wait. Maybe future SIPs he can stop, I mean, if his income stream stops. But at least let these funds remain, and then we can take it as it comes here.
Coming to the education loan, Jayant, would you give certain idea in terms of the interest rates, or how does one go about? Because while we have sort of addressed Pratyush's query, there are a lot of viewers who would perhaps be wanting to know more about drawing inferences from these queries. So if you could highlight on the education loan a little bit.
Yeah, so education loans are of two types. They may be secured or unsecured. Loans above a certain figure, it used to be 4 lakhs earlier, now even banks give up to 7 lakhs without security. But beyond that, they require a security, and prior to 7 lakhs they would require only a guarantor. Usually the parent will act as a guarantee. That's a personal guarantee. Beyond that, they would require some collateral, say or PPF or something as a hard security. And otherwise, the one good point about education loans is that in many cases the EMIs do not begin until the student actually finishes the course.
That's true.
But of course the interest will keep accumulating. So
it's better you start earlier and start repaying.
I really suggest that even if you are in a capacity to start repaying, please do so immediately. Don't think that this is a free lunch, that your EMIs will begin later on, because it all accumulates. Okay. But basically this is a very good mode of funding your education as compared to selling your investments or taking a personal loan or something. This is a pretty cheap one. I mean, the interest rates are around 11-12%.
12%. So
yeah.
I mean, as much as that.
Yeah.
All right. Pratyush, as Jen just told you, firstly, as far as with regard to the kind of savings that you're doing is really good at this point in time. What you really need to look at is the way of sort of disposing your education loan or paying off your education loan before you head in terms of taking another loan or looking at other sort of income as far for your higher studies is concerned. You've chosen good plans, and we would recommend, and Jayant rather would recommend that you please continue with these plans.
Investment Ladder, presented by the Bombay Stock Exchange, IPF.
Well, on that note, we'll take a short break, but we'll be back with some term busters in just a bit.
The Financial Planner, presented by the Bombay Stock Exchange, IPF.
Welcome back to the Financial Planner, and with me is Jayant Pai, who's been advising us and taking us through various sort of equity questions about different kind of shares, etc. And this time of the segment is about term busters. Term busters are essentially various terms which are commonly used, but somehow we do not know what really it means. And the term that we are picking up today is market cap, or market capitalization, as we say. What does it mean?
Okay, it's simply a product of two things. One is the number of equity shares that a company has already issued so far, okay, multiplied by the current market price. For example, if a company has 1,000 shares in the market and the current price is say 10 rupees.
Okay.
So the market capitalization will be 10,000 rupees.
Okay.
Okay, so this is the basic definition. There can be certain nuances to this. Like now the term in vogue is free float market cap.
Okay.
So free float is a very simple thing. It simply refers to the amount of shares not just issued but actually available for trading in the market.
Okay. Now,
one very simple thing is that from the number of shares which are issued, just subtract the promoter holding.
Okay.
So for example, out of 1,000 shares, if a promoter holds 500 shares, so only 500 shares are available in the market
to be traded.
Yes.
And that's what free float market cap would.
Right. So the free float market cap always is lower than the
overall market
headline market cap.
Yes.
Yeah.
Yes.
So in this case, 500 into 10. So 5,000 will be the free float, 10,000 will be the market cap.
So when we talk about, you see headlines in the newspaper, the market cap of X company fallen down by about 20% or 50%.
Okay.
First question, so what it really means is that the share price has really gone. So what the market cap was has fallen down.
Yes.
And therefore it means really bad for the company. Is that so?
Yeah, I mean, since all of us like higher prices, so lower price is bad in that sense. But these falls in market cap may be for a variety of reasons.
Okay.
And there are some investors who would actually treat this as a point of entry rather than exit, especially if the price has fallen for some absurd reason.
Well, Jayant, on that note, we'll have to end the show because we've really run out of time, and thank you so much for advising our viewers with regard to various issues that we discussed today on this show. Well, we've come to the end of this show. We'll be back and we'll be talking more and guiding you more. So keep watching Financial Planner.